I'm joined now in the studio by another ex-colleague and friend of mine, Mike Adsetts, the Global Chief Investment Officer now of Momentum Multi-Manager. Mike, welcome. Thank you for joining us.
Leon, thank you very much, and always a pleasure to spend some time with you.
Mike is one of the tallest people at the conference this year. We've had to adjust all of our equipment to do this interview. Mike, you just came out of doing a talk to the attendees at the conference. Can you give us a bit of insight into what that talk was about?
So basically it was the infrastructure opportunity and challenges, and kind of trying to understand what is the disconnect between the feel-good part of the story, which says infrastructure is essential, there's a great need for it, you're getting decent returns for it, but the reality is that the allocation within funds across the industry are of the order of 1 or 2%. So it really was unpacking the case for infrastructure. So saying, depending on the type of infrastructure, there is a GDP multiplier. Some types of infrastructure go into the fabric of business architecture far better than other types of infrastructure, so there's a higher multiplier. So social infrastructure has a higher cost, lower GDP multiplier. Something like logistics and transport has a much higher multiplier effect, so came through that. Where's the nodal concentration of infrastructure development? Surprise, surprise. It's in Cape Town, Joburg, and Durban. Where is the needs are not really in those places. The biggest needs are, so there's a misalignment of those needs. And also there is an inverted pyramid of capability, with national government having the highest capability sets and municipalities having the lowest capability sets. But the reality is that most delivery happens at a municipal level. So you do need to try and close that gap in terms of how do you focus infrastructure to get to where it goes within the construct of what's possible. And then I went through a practical example of how we think about it within Momentum Investments, and taken it from the perspective of the capital stack. So it was a blended finance perspective. So essentially saying, starting with cash, bonds, mezzanine debt, going up to equity, what are the opportunity sets, what are the characteristics, and importantly looking at what does a fund look like. So you actually want to fish where the fish are, so go look for capital where capital is. And if you look at the architecture of the pension funds in the country, our funds are equity centric, so you need to deliver more equity type capability to unlock the bigger allocations. And then another overlay was, I think there's getting to a realization that there's a bigger need for listing of these types of instruments, because unlisted instruments tend to have a lot of illiquidity, difficult to get in and out. And when we put all those together, the infrastructure is lower down on the capital spectrum, it's out of the main systems, and it's difficult to get into and out of, means that the allocations are going to be low, because portfolio managers are cautious by nature, and they're getting mandates from clients that are very performance and peer group performance orientated. So kind of putting all that together, there is a disconnect between what we want to do and what we're seeing on the ground.
Mike, the average board of trustees for a standalone pension fund, they rely on either an investment consultant or, if they've invested with a multi-manager, to ultimately deploy those assets in the way that they deem to be appropriate according to the mandate given to them. So a lot of what you're talking about shows that there's expertise in terms of how to ultimately invest the monies. But to expect a board of trustees to make the call to select that specific asset type is not what they are traditionally used to. Are you talking from the perspective of encouraging trustees to think about infrastructure investment, or to justify yourself as a multi-manager investing into infrastructure? Or I bet the answer is both.
So there's a little bit of both. So where I'm coming to it, we get given mandates, and the mandates are really structured around high levels of liquidity, long-term growth, and where you do have allocations to unlisted, it's either as a side pocket investment or a very low investment. So for us as asset managers and multi-managers to make bigger investments into infrastructure, we need our mandates to become more all-encompassing, and for those mandates to allow for those nuances and peculiarities of the infrastructure investment, consultants need to be educating trustees, and trustees need to be comfortable that they are making these types of investments. So, that's kind of one of the things that we are advocating for. I have performance mandates, generally at reasonable to low cost, and that's what I would need to deliver on. If I'm going to take an off-benchmark bet, my portfolio managers make off-benchmark bets in the portfolio, they're going to really weigh up what the cost benefit is and also the complexity of those investments. You do not want to be sitting with the board of trustees. You get an opportunity to speak to them for half an hour to an hour, 4 times a year, to kind of explain the intricacies of unlisted mezzanine debt that makes up 0.5% of the portfolio. You'd rather just not invest in it.
Everyone's talking about the concept of impact this year at the conference, for good reason. The skeptic says, well, it's a fad. It's the latest trend that's taking place. Now, you're not talking about impact, but infrastructure at the end of the day is important in South Africa from an impact perspective. So what's your view on that? I mean, is this a fad? Is this something that's here to stay?
It's a very nuanced answer, and I think there's elements of truth to it, because if I look over the last couple of years, you've had ESG, sustainability go in and out. It's all artificial intelligence now globally, infrastructure. So I think there's definitely elements of faddishness, and one of the conversations, thinking about your background, is to what extent does marketing capture the message, and it's a feel-good message versus where's a fundamental problem that's not going to go away that you need to address. So it does span both those dimensions. I do think there's a lot of hype and excitement around things like infrastructure now, because it's very fungible and you can see the impact, and you can see when things fail over. I mean, you just need to drive home to see the realities of that, and just drive around Cape Town to see the realities of, if there is proper infrastructure and maintenance in place, what a different environment it is. So the hype creates interest, but there's also always something fundamental and that doesn't go around. So I think if I think about sustainability and Trump in the office now around climate change, nobody really wants to, in the US, talk front and center about climate change and sustainability in funds. So they've kind of downscaled the marketing message, but the reality is climate change isn't going away, and there's real impacts. I mean, one of the consequences of his views of the world is a lot of the conversation has gone from mitigation to adaptation. So we probably can't prevent it anymore, but how do we adapt to it? So, a lot of these things, there's a kernel of truth to that. It can kind of get a life of its own. So you've also got to be mindful just to pull yourself back to the realities. And that accounts for things like sustainability, transformation, artificial intelligence. They're not going to go away. They've got a popularity curve that they're going through. They're capturing the attention economy for Euro now. The trick for a fiduciary is to say, look through the noise. What is the real thing there? And what do we need to commit to for the long term? And that's kind of part of the duties of being on a board of trustees, being a consultant, being a multi-manager.
I think it's also about accepting the fact that while the responsibility is to solve for members' retirement, so to generate turns so that they can retire with sufficient capital, at the end of the day, we're also solving for younger members who will only be retiring in 30 plus years into an environment that hopefully will be fruitful thereof, but also that when even today's near retirees reach that stage, the cost of retiring is so much higher because of some of the lack of infrastructure and other aspects that are just realities in our lives. So I think simply solving for return is only one side of the coin at the end of the day.
And you must be respectful of what the client demand is. So if the client demand is going for returns, I think everybody buys your argument that part of the benefit of retirement savings is to deploy it in a way that makes the environment better for the future. As an investment manager, if I don't have money to invest, I can't do anything. So you've got to be sensitive to the client directive. That's why education is so important. So as you move in this, and there are constraints, liquidity constraints, duration constraints, to take into account that you take the clients who are issuing the mandates along the journey so they understand the trade-offs, because if they don't understand the trade-offs, they're just going to look at it from the view of performance or peer competitor performance and say, look, here, you're not stacking up. I'm going to take the money away. So it's a broader problem, and all of this kind of manifests in the fact that even though we know we need to do it, it's just not happening at the pace and scale to make a real difference in our environment yet.
Fair enough. And I just want to go back to the liquidity point that you made. You said there's a need to list these unlisted investments. My experience, and perhaps naively, has been that where that has been tried elsewhere in the world, you end up with major liquidity sort of premiums within those listed vehicles. So are we not just repeating something where lessons have been learned elsewhere?
So I think there's an element. If I think about the guys that manage funds for us in the UK, so they've got investment trusts there, which are listed vehicles for utility. And yes, there is a discount in those vehicles. Yes, they're less liquid than the listed markets, but they are definitely a lot more liquid and easier to price than pure unlisted vehicles. So one of the challenges that we also have in the current environment is when you make an unlisted investment, it kind of like the first thing that happens when the alternatives team looks at an investment, they come to me with an NDA. So, okay, sign the NDA. So there's like limited levels of transparency and understanding. So if a client ever gets to a point where they want to terminate a mandate and you need to transfer the unlisted investments to another vehicle, there's a whole journey of discovery that you need to go through with your counterparty to say, we actually cannot liquidate 100% of the portfolio quickly. There's an element that needs to be ring-fenced and stay behind. So it also addresses that component, the need for a more robust secondary market. So it's not an ideal solution, but it is, in my opinion, a mechanism to facilitate a lot of this stuff. I just don't think that a pure unlisted black box investment surrounded by NDAs is going to get like the trust and confidence of investors to chase after them.
Fair enough. And while I've got you, final question, then I will let you go. But you mentioned blended finance. I don't think that's a concept that's well known in South Africa. So for the sake of our viewers, can you just explain what blended finance is?
Okay, I'll explain it from a business perspective. So a business needs to do something and it needs money to do something. So how does it raise that money to initiate the project or fund its operation? So it can go to very short-term overnight funding, cash-type investments. It can issue bonds that have a slightly longer duration, but there's more certainty of payback, but you take the counterparty risk. Or you can go to equity-type investments where there's a higher promise, expectation of reward into the future, but there's a risk that nothing comes back and it's a longer-term duration. So that's essentially the capital structure of when somebody in a company wants to raise capital, how do they think about it? What are the attributes that they are looking for? And that's what blended finance is, chopping up an investment type into different components of the capital spectrum. So you can take one project and you can have an equity component, you can have a mezzanine finance component, you can have a bond component, you can even have a cash component to meet different kind of terms and different kinds of financing need. You put that into the mix and that's blended finance.
Okay. So I think what's great to hear, because we started off the conversation around, is this a fad or not? The fact that all of this is being discussed, debated, explained, shows that there is substance ultimately to it all. So well done to you for being one of the brains in the market that's pushing this discussion forward and sharing with others and looking at it from a client perspective. If any of our viewers would like to get a hold of you to continue the conversation, how can they do that?
Quite easy. So I'm on LinkedIn, Mike Adsetts. Otherwise, mike.adsetts@momentum.co.za.
And I promised I'll share your cell number as well.
Please do.
All right. Mike, thank you so much. I wish you all the best, and to the rest of your team as well. And we look forward to you remaining a friend.
Leon, thanks for catching up. Really enjoyed it.
Cheers then.